One of the greatest growth investors, Philip Fisher, had this to say about overpriced stocks. If the growth rate is so good that in another 10 years the company might well have quadrupled, is it really of such great concern whether at the moment the stock might or might not be 35% overpriced? My stocks sometimes get overpriced, but in the long run this kind of company, if you can find it, will outperform the market and the economy. The worst thing you can do is try to catch the swings, sell out too soon, and be afraid to buy back in. His most famous investment was his purchase of Motorola, a company he bought in 1955 when it was a radio manufacturer, and held it until his death. Fisher is remembered for using and proliferating the Scuttlebutt or grapevine tool, in which he searched fastidiously for information about a company. When you scuttlebutt, you make more informed decisions, do a better basis for analysis and valuation. Who is Philip Fisher? In the 2018 Berkshire Hathaway annual shareholders meeting, Warren Buffett called Fisher's Common Stocks and Uncommon Profits a very, very good book. He further described how using Fisher's scuttlebutt technique continues to be a good way to investing, which is still used by Ted Weschler and Todd Combs at Berkshire Hathaway. John Train described Warren Buffett as 85% influenced by Benjamin Graham and 15% by Philip Fisher. Scuttlebutt is a term coined by Philip Fisher. It refers to a method of conducting due diligence about a company and its investment merits by talking to all kinds of people related to it, like customers, vendors, trade associations, competitors, and employees, former and current. It is true feet-on-the-street research. This is, of course, above and beyond all the financial statement reading and standard due diligence that a prospective investor is expected to do,